Good morning, everyone, and thank you for joining me for this morning's SURF webinar. My name is Eva Majorova, and I head up investment consulting at Sygnia Asset Management. In today's session, I want to go back to basics and to help members and management committees understand exactly how the retirement fund works. So I will start at the beginning, explaining how contributions get taken off, and then I will explain all the various asset classes that we invest into. And at the end, we'll cover some of the performance. The latest figures that we have are as at the end of May 2021. So SURF stands for the Sygnia Umbrella Retirement Fund. So how does the fund work? And in fact, how does any retirement fund work? Well, to put it simply, every month you get contributions deducted from your salary. So your employer withholds employer and or member contributions from your salary, and then they pay these over to SURF. But often there's a misunderstanding between how much gets taken off your salary and how much is invested. And we have to understand that before monies are invested, very often some fees have to come off. Now, different retirement funds, different employer groups have different benefits. They might have different services from various consultants. So depending on the exact structure of your specific retirement fund, that will determine what fees are deducted. So you would likely receive some sort of newsletters or a member booklet, some sort of communication that will have the exact fees that are being deducted from your contributions. But speaking at a high level, often there are admin fees that get deducted. So the Sygnia Umbrella Retirement Fund does not charge administration fees, only in some very specific circumstances. But typically, in any other retirement fund, you can expect that from the contribution that is taken off your salary, some administration fees will come off. Then your management committee that looks after the retirement fund often would look to certain experts to provide them with advice. And depending on whether a consultant is appointed, there may be some consulting fees that are applicable as well. And then I'm not sure if you would have noticed, but a lot of you would have some type of benefits. So if you receive, as I said earlier on, if you receive some type of a newsletter or a member booklet, you'll often see that you have some cover for a death benefit, you have cover for disability should you become disabled, and you may also have funeral cover. Now, to pay for these benefits, insurance benefits as we call them, we have to pay premiums to one of the insurers. And of course, that comes at a cost. And these are also fees that get deducted from your contributions. And once everything is deducted, so there could be admin fees, there could be consulting fees, depending on what sort of benefits you have. There's some insurance premiums that we have to pay. Now, the remainder of your contributions gets invested. So this is often where we receive a lot of queries, and there's a little bit of a mismatch in understanding between how much got taken off your salary, and if you look at the statement and you see that less than that is actually what has been invested. So to give you more of a practical examples, imagine that your contributions are 10% of your salary. Your admin fees are 0 because there's no admin fees for SURF clients. Maybe a 0.5% for a consultant that is giving expert advice to your management committee. And insurance premiums, let's say that your death, disability, and funeral benefits altogether come to 1% of your salary. Now, you may think that 10% gets taken off your salary and that full 10% is invested. But as I explained, unfortunately, the deductions happen first. And I mean, it's not necessarily unfortunately, we have to pay for, services and pay for insurance. So once those fees are deducted, it's only the remainder that gets invested. So let's follow this graphic and this diagram over here. So your contributions 10% is in this example, minus fees. So that will be the total of all the fees, be it admin, be it consulting, be it insurance premiums. In our example, we've used a 1.5% for all of the fees. So 10% minus 1.5%, only 8.5% of the money is actually being invested for retirement. So it is important to understand that, because as I mentioned to you, we do often receive a lot of queries. You thought 1,000 Rand got taken off your account, but you see that 850 Rand is invested. This is the reason why. We have to make some deductions first, depending on your specific benefits or your company specific benefits, and the remainder gets invested for retirement. Now, where is it getting invested? We know that in the Sygnia Umbrella Retirement Fund, we follow a life stage model. So the default for members is a life stage model, meaning that members are invested in portfolios that are age appropriate. So younger members would have a slightly more aggressive portfolio than older members. Older members closer to retirement would have a more conservative type of portfolio, and that mix of assets in that conservative portfolio are quite different to the mix of assets in the aggressive portfolio. And I will cover some of those details a little bit later on. There are 3 different life stage models, which I will cover as well. And in addition to that, if the life stage model doesn't suit you as a member for whatever reason, then you can create your own investment strategy. There's a list of portfolios that you can choose from. And of course, we do recommend that you do obtain financial advice from a registered financial planner should you wish to make any changes to the investment strategy of your retirement fund. You can at any stage switch your portfolio. We do understand that people's individual circumstances change from time to time. You might be retiring early or planning to retire later. So the life stage model works for 99% of members, but sometimes there are individual circumstances where there are reasons why members want to be in a different portfolio, or they may feel very strongly about a certain asset manager and you want to go into that asset manager's portfolio. That is absolutely fine. Members can switch at any time, and there's no cost to switching. So we will not penalize you for wanting to make an active investment choice. The life stage model, as I said, does de-risk your members from a more aggressive portfolio to a more conservative portfolio. So how this de-risking will work for the members of your funds is starting 6 years before retirement, you will be invested in what we call the 70 portfolio. And as you start getting closer and closer to retirement, so from 6 years on until 5 years before retirement, 4 years before retirement, 3 years before retirement, as you get closer and closer to retirement, your members will be de-risked. So they'll move from the 70 portfolio to a mix between 70-60, then to the 60, then a mix between 60 and 50, and so on, until 1 year before retirement, members are invested in a more conservative portfolio. Now, there are 3 different life stages available for management committees to choose from, and these are a passive option, a passive and active blend, and an active balanced portfolio, which is called the Synergy range. So I will cover those details as well. So what are the differences between these 3 different life stage models that a lot of you listening to me today are management committee members that you need to choose as a default for the members that you are looking after? So the skeleton and the synergy range. The difference there is that one is totally passive, being the skeleton range, whereas the signature range is an active and passive blend. But from a construction perspective, the way that these portfolios are constructed, we call that construction process a specialist approach. So if we look at this diagram on the left-hand side, a specialist approach is when you take your portfolio, let's think about the 70 portfolio, be it skeleton or signature, one of the 70 portfolios, and we decide upfront what percentage needs to be in equities, what percentage needs to be in bonds, and what percentage needs to be in cash. In other words, in these two ranges, the skeleton and signature range, Sygnia controls the asset allocation. So we decide up front, based on modeling, based on our forward-looking views of where we believe asset classes will be. We find that perfect mix of assets that we believe over the long term will give you those inflation-beating returns. Once we've decided, say, for example, that 50% needs to be in equities and 15% needs to be in bonds, we then decide what strategies should we then invest into to give us those inflation type of returns over the long term. Now, in the skeleton range, once we've decided how much needs to be in equities, we're simply choosing a passive strategy. So it has to be low cost, it's passive, it's an index tracking strategies, and that's how we gain access to the equity markets. Whereas in the signature range, where we're using active and passive as a blend, we will choose some active managers as well as a passive component that is able to keep costs low. But the point of the specialist approach being is that you decide on the asset allocation up front. So you're deciding on your mix of assets first, and then you're choosing the best equity strategies or managers for the equity portion, the best bond managers for the bond portion, etc. Whereas the synergy range is what we call a balanced approach. In the synergy range, Sygnia is not deciding on the asset allocation upfront. What we do in the balanced approach is we first divide the portfolio between a number of managers. So in this diagram, just as an example, you could give a third of the portfolio to each asset manager. So let's say, for example, a third to Allan Gray, a third to Coronation, and a third to Prudential. You then say to these asset managers, it's up to you where you would like to invest, provided that you comply with all the regulations. So Regulation 28, for example. So these asset managers will make their own decisions depending on their views of the market, on whether they want to have a little bit more equities, a little bit more bonds, a little bit more cash or property. So that asset allocation decision is then handed over to the Allan Grays and the Coronations of the world. So it's just a difference in thinking. In all three of these life stage models, you will have great diversification between a lot of different asset classes and instruments. It's really a decision on whether you believe that Sygnia should control the asset allocation or whether that should be handed over to the single asset managers. And very importantly, the offshore component of all three of these life stage ranges is exactly the same. Now, whether it's the signature, skeleton, or synergy range, all of these ranges have a 40, 50, 60, and 70 portfolio, and the numbers in the names of the portfolio are an indication of the approximate equity allocation. Now we'll cover, equities, bonds, the various asset classes in the next couple of slides, but those indications are really to know, for members to know, how aggressive that portfolio really is. And this diagram helps to explain it. If you look at risk on the horizontal axis, the further right you look, the more risk a portfolio is taking on, and the return is on the vertical axis. Now we can see that money market, for example, if you're investing in money markets. We know that money market investments are not very risky. If you go and you open up a money market account at a bank, it's very unlikely that you will lose your money. So that's why risk is quite low. It's very much to the left. So it's a low risk investment, but you also don't expect a very high return. You don't expect to put your money in a bank and to go back 3 months later and it has, doubled or tripled in value. We know that money market investments typically just earn a little bit of interest. Then the next set of portfolios on the risk spectrum are the 40 portfolios. They only have about 40% invested in equities. So equities are shares of companies, which I will cover in a little bit more details just now. But when you're investing in equities, it is a little bit more risky, but only 40% is invested in equities, meaning that the other 60 is in safer type of asset classes like bonds and cash. So low risk, higher than the money market, but still pretty low on the risk spectrum, but then the expected return is a bit higher. Then the 50 and 60 portfolios are considered medium risk. About half of the portfolio in the 50 portfolios, about half is invested in equities, meaning that the other half is in bonds and cash. So higher on the risk spectrum, but we do expect a higher return over the long term. And then your 70 portfolios, and this is where members are expected to spend the majority of their working lives being invested. These 70 portfolios have roughly about 70% invested in equities, meaning that only about 30% is invested in safer type of asset classes like bonds and cash. But investment theory tells us that the higher the risk, the higher the return over the long term. And your single manager portfolios that are available as member investment choice, they're also on the higher risk spectrum. So you do take a little bit more risk, but the return that's expected over the long term is higher. So now let's chat about what we actually invest in. I've already used a lot of words like equities and safer investments like bonds and cash. So let's try to unpack that a little bit. So what are asset classes? So an asset class is essentially a grouping of instruments that have similar financial characteristics and they behave in a similar way. So I spoke about equities. So for example, all those numbers in the names of the portfolios that are an indication of your equity allocation. So equities are essentially stocks. Then you have fixed income or bonds, a bit more of a safer asset class. You have cash and cash equivalents. You have real estate, property. You can invest into commodities. And all of these are asset classes on their own. Now, when you compare one asset class with another, usually there is very little correlation between them. So what does correlation mean? If you look at the charts that I have included at the bottom, positive correlation means that asset classes move in line with each other, and negative correlation means that they move in opposite directions. Now, ideally, you would want to mix together assets that don't behave in the same way, so that when one is not doing so well, maybe another asset class can actually be doing well for you. And the mix of assets that we have in these life stage portfolio is a very well diversified mix of assets. If there are times when the equity markets don't do well, then your cash and your bonds will do well. So we don't expect them all to behave in the same manner. And this is the reason why we don't just invest in one thing. Firstly, there are regulations that are forcing us to have a very well diversified portfolio. But secondly, we also want to make sure that no matter where the market is, that there is some asset classes that are performing well under any market environment. I spoke about risk and return a little bit earlier as well, when we looked at the various life stage portfolios and where they kind of fit in on the risk and return spectrum. Now, the same goes for the underlying asset classes. So again, looking at this little diagram at the bottom, the further right you look, the potential risk of an investment increases, and the more to the left it is, the less risky it is. So as I mentioned, cash, not very risky. You put 100 Rand in the bank today, you go there in 3 months' time, you can almost be sure that your 100 Rand will still be in the bank, maybe even with some interest. So cash is low on the risk spectrum, but as we said a little bit earlier on, we don't expect a very high return over the long term. The next one on the risk spectrum is government bonds. So with government bonds is essentially you lending the government money and you expect the government to be able to pay you back. There's a lot that they can do before they default, and that's why lending money to the government is theoretically safe. Then you have some higher yield, a little bit more risky bonds. These could be corporate bonds, for example, when you're lending money to a certain corporate. And provided that company doesn't go under, you should also get your money back, but it is considered higher risk. Then you get large company shares. So companies that are very well known, like Naspers or like an MTN, we don't expect them to be here today and not to be here tomorrow. So if you invest in a company such as Naspers, it's risky because it's a company share, yes, or it's more risky than cash and bonds, but the larger the company is, the more you can be certain that they will be around tomorrow. Whereas small company shares, if a company just started not so long ago and they're still relatively small, maybe they're not as profitable and their balance sheet is not as sound as some of the big companies, it is a little bit riskier. Maybe we're not so sure that this company will still be around in 5 years' time. That's why it's higher on the risk spectrum. And then venture capital, these are really just startups. With a lot of startups, they don't really, companies don't always succeed. So as much as the potential is huge, I mean, imagine being one of the early investors in Facebook, for example, back in the day. The risk at that stage would have been high. That's why it's higher on the risk spectrum. But your reward, should the company succeed, is also very high. However, a lot of startups or new companies also, don't make it. And that's why it is higher on the risk spectrum as well. Excuse me. And this is just an explanation of how different investments do have different risk and return characteristics. So we speak often about equities. You receive a lot of communication for your members that talks about the equity markets, how these have performed, and especially in the 70 portfolios, about 70% of those portfolios, as the name suggests, is invested in equities. So we often, focusing on the equity markets, where the equity markets are, because that portion really does drive the performance of these portfolios. So what are equities? Well, equities are essentially buying shares in a company. So if you're buying stocks, you're buying equities. I've included some, well-known companies in South Africa just to try and provide you with more of a real example. So if you're buying a share in Naspers or in the MTN, that's investing in equities. So how do people make money off equities, or how are we able to create a good return in your retirement fund portfolios when investing in equities? Well, there's two ways that you make money from an equity investment. Firstly, a lot of these companies, when they generate profits, they distribute some of that profits, and we call that dividends. So if you're holding, for example, an Naspers share for many, many years, even if you choose not to sell it, that company may pay dividends, and that dividend income is, of course, beneficial to you, and it is a way for you to generate some income from your shares. But we also know that share prices go up and down, and people and fund managers very often are buying a specific share for the opportunity to make a profit out of it. So if you buy something at 10 Rand today and you sell it at the end of the year at 20 Rand, then that's how you can make money from buying and selling of shares as well. So as a practical example, and using Naspers, if your fund manager, say for example, you are invested in the Allan Gray portfolio and the Allan Gray fund manager decided to buy some Naspers shares back in May 2015. At that stage, a Naspers share cost 1,841 Rand. And the manager decided for this big pool of money that he's managing to buy 1,000 shares. So he spends just over 1.8 million Rand to buy Naspers. Now, throughout, each day and from day to day and from month to month, share prices do not stay the same. They're constantly moving. So if you look at this little chart that I have at the bottom, you'll see that the share prices go up and down. And the reasons why these share prices goes up and down is dependent on many, many factors. It's dependent on investor sentiment. Say, for example, there was some bad news about Naspers in the newspapers. I'm sure that the price would go down. A lot of people would be like, oh, think to themselves, well, maybe Naspers is not doing so well. They're not doing great things for employees or the environment or some other negative news. People maybe will start selling Naspers, then it will go down. If we had to hear positive news, say, for example, Naspers is doing so well financially and they've got all these projects that's going to make them really profitable over the next couple of years, then the share price would go up. So there's various reasons why, there's supply and demand, there's profits, there's what the company's future plans are. And based on all those reasons, the price does go up and down. Now, Allan Gray, as in this example, has been holding these Naspers shares since 2015. In May 2020, 5 years after buying the shares, they decide to actually sell them. Now the price in May 2020 is 3,110 per share. So this asset manager had 1,000 of them. They sell all 1,000 shares, and now they actually realize just over 3.1 million when they only paid 1.8 million or so for the shares. So that is a good example of how money can be made from the stock markets. Just in another example, and you can think about any shares, if you buy shares at 10 Rand, you buy 1,000 of them, you've spent 10,000 in company X. Again, the share price can go up and down, and 5 years later, if you sell it for 20 Rand a share, then you've really doubled your money. But the opposite is also true. Not every investor, not every asset manager can always get the timing right. Companies, as we said, are affected by a lot of sentiment, a lot of news flow, depending on their profitability, what they experience in the marketplace. And sometimes, unfortunately, share prices can also go down. So you could also have a situation where you buy a company for 10 Rand a share, and maybe it just keeps going down after that. And some asset managers may not be patient or want to wait, or they may believe that it's impossible for a company to realize its true potential, and they may actually very well decide that although I bought the share for 10 Rand a share, unfortunately they might say, well, I'm going to have to sell it, and I sell it at 8 Rand a share, and that's when you realize losses in your portfolios. Listed property is another asset class. So now we've just spoken about equities. Equities, asset class on its own. Listed property, another asset class. We don't have any direct exposure to listed property in the skeleton and signature range, but today's presentation is more high level to help in the understanding of the various asset classes. And as much as we don't have any direct exposure to listed property today, it's not to say that at the end of the year or next year that we won't make a direct investment into listed property. So property, because these are, buildings and shopping centers and malls that we see around us, sometimes it's easier to understand or interpret how the investment into this asset class would work. But essentially, the asset class known as listed property is comprised of property companies, and these property companies develop or manage real estate. So there's certain property companies, for example, that own a lot of the malls that we frequent. And how do they make their money? Well, they own the malls, they have tenants, there's a lot of shops and restaurants that rent from them, and these tenants then pay them rent, and this rental income is how they make their money. And you can consider property almost like a share, because you are buying, a share in that property company, and those shares also go up and down like any other shares. But from an income perspective, property companies tend to have, much higher or more regular income because of the tenants that they have, be it residential or commercial property. So how does listed property earn its returns? So as I said, because it's like an equity, you can produce a return through the simple rise or fall of the share price. So think about the examples that we spoke about earlier. If you're buying a property share for 10 Rand and a couple of years later you manage to sell that very same property share for 20 Rand, well, you would have made a profit. But in addition to that, there is income in the form of regular shareholder distribution, and that really comes down to the rental income that's earned from these companies. The properties can be, very similar to equities, as I mentioned, but that income generation, can be viewed quite differently. So we've spoken about equities, we've spoken about properties. Bonds, we often speak about bonds, and there's often a lot of confusion when it comes to bonds. So bonds, bonds is what we call that whole asset class is essentially fixed income. And the way to think about it is you really, as an investor, lending money to the bond issuer. So that could be a government or that could be a company. And if you lend the government 1,000 Rand, the government promises you that they'll pay you 1,000 Rand back at the end of the term. The term could be a 1-year bond, it could be a 10-year bond, it could be a 5-year bond. So the terms of the bond will be there. So if you lend the government or a company money, they promise to pay that money back to you. But in the space, say for example, it's a 10-year bond, between now that you've given them your 1,000 Rand and 10 years time when you get your 1,000 Rand back, you wouldn't want to lend someone money just to get the same thing back at the end of the period. So what the bond issuer promises as well is to pay you coupons, and these coupons could be fixed or flexible, and they're very much linked to the prevailing interest rates. So again, there's two ways to make money in bonds. So either hold the bond to maturity. That means that the full term of the bond, be it 5 years or 10 years, and in between this period, between the time that you've given your money to the government or this company and the time that they pay that money back to you, you're also receiving the coupons. So overall, you should be better off. You've given them 1,000 Rand, you're going to get your 1,000 Rand back, but in between, you've also received these coupon payments. Or just like with any other asset class that we've discussed, these prices do fluctuate, so bond prices also fluctuate, and there may be an opportunity for you to sell a bond to somebody else at a profit. And then cash. So cash investments, typically, as we saw on the risk-return spectrums on all those charts, lower risk, but we also expect a lower return. So as much as often we feel, oh, maybe we shouldn't take any risk with our retirement fund portfolios, unfortunately, if you just had to leave your money in cash, you will not get these inflation-beating returns over the long term. don't invest only in cash. We all want, you know, a really good and safe investments, but if you're just investing in cash, you cannot expect that over the long term you will have these inflation beating returns that will help you to retire. Cash can be broken down into savings accounts, money markets, or certificates of deposit, and it really talks to more of the short-term nature of these instruments. Then we can also invest outside of South Africa. So the regulations at the moment state that a retirement fund can invest up to 30% offshore. Excuse me. When you're investing offshore, you can invest into pretty much the same asset classes that we invest in locally. As I explained, this could be property, it could be equities, it could be bonds, it could be cash. So when you're investing that 30% offshore, we're again talking about offshore equities, offshore bonds, offshore money market, offshore properties. I've included a few little logos of companies that you are probably very, very familiar with. You know, companies such as Apple or Tesla or Microsoft. And these are companies that retirement funds could have exposure to on the global side. And after everything that I've explained, we have to follow Regulation 28. So I mentioned this a little bit earlier, but this regulation really tells us where we can and can't invest retirement fund monies. The regulations have been put in place to protect members, to make sure that asset managers manage retirement fund portfolios in a very diversified manner, that we don't put all your eggs into one basket. So we're not simply investing in equities, for example, or even worse, very concentrated in one stock. We're not saying, okay, we think Naspers is going to be the best thing, let's just put all your money in Naspers. There's a lot of diversification. So some of the key limits, for example, is that we cannot have more than 75% in equities. So as much as we know from the theory that, you know, with equities, we can expect a really high return over the long term. So yes, you are taking on some risk, you will stomach some volatility, but over the long term, the theory tells us the higher the risk, the higher the return. And that's why we do have more equity exposure for the portfolio suitable for younger members, but we cannot exceed 75%, meaning that at least 25% of your portfolio will be in other asset classes, so that you don't have all of your eggs in one basket. You can only invest 30% offshore, so meaning that 70%, the bulk of your money, is actually invested in South Africa. You can also invest 10% into Africa. So Regulation 28 and these limits really are there to make sure that we have a diversified portfolio and that it's managed well, and that it is there to protect members. And there's also, not only have we spoken about the various asset classes, when we looked at the portfolio constructions of the different life stage models, there was the specialist approach where Sygnia controls the asset allocation. There's the balanced approach where we give that asset allocation decision on the local side to the asset managers. But there's also the active and passive that we spoke about. So really, the skeleton range is totally passive. The signature range is a blend between active and passive, and the synergy range, especially on the local side, is totally active. And just to summarize, I know we've spoken about active and passive a lot before as well, but really active portfolio management is when you're trying to outperform certain indices. So typically you are paying for skills. So you would be paying the Alan Grays, the Coronations of the world, and you're paying for their skills, their teams that are going out, they're researching companies, they're trying to find out, you know, what the future prospects of companies such as Naspers may be. And, you know, depending on all of their analysis, and they're looking at financial statements, and based on all of their research, they will decide what sort of portfolio they want to construct. Now, you're paying for that. These are expensive people. They have studied very difficult things, and they are that work comes at a cost. So that's why active management is more expensive, because you're paying for these expensive teams of professionals to now go and make decisions of what stocks they really believe will outperform over the next couple of years. Whereas passive is when you're just replicating a benchmark. Now, a benchmark could be a group of, and I'll cover what a benchmark is a bit later on as well. But essentially, if you think of the JSE top 40, for example, it's the 40 largest, most liquid stocks listed on the JSE. If you're a passive manager, you will simply buy those 40 stocks in those exact same weightings. So you don't have to have this expensive team of all these different analysts and portfolio managers to decide, which stock should I buy, which ones shouldn't I buy. You're simply replicating an index. And there's so much data that actually shows that, passive management really does perform just as well, if not better, in many, many periods than active portfolio managers. Often, the decisions that these active managers make, not to say that they're bad decisions, but often these decisions don't work out. And on a net fee basis, so if you minus that higher cost that you're paying for active management, whereas the low cost that passive is, if you're looking at both of them on a net fee basis, more often than not, passive investing really does make sense, and passive strategies have outperformed markets. So I hope that everything up until this point hasn't been, too confusing. I hope that, you as management committees and consultants, and if there are some members listening, that you had a general understanding of asset classes, but sometimes going back to basics and really understanding or trying to explain it as simply as possible does make sense. So now that we know how the life stage model works, what type of asset classes we invest in, let's then look at the investment performance, and hopefully it will all make a lot more sense. So looking at firstly the market's performance, what did markets do to 31 May? And I never like to focus on the shorter term figures. In a retirement fund, we are investing for the long term, so we should be looking at 10-year, plus performance. But because we do, look at the portfolios quite regularly, I always like to focus on the 1 year, as much as we should always be focused on the long term. So looking at the performance over the 1 year, if you just, look down this 1 year column, you'll see that for the most part, very good double-digit returns across from various asset classes. Now, when we looked at the portfolios, and we know that most members are invested in the 70 portfolios, with about 70% allocated to equities, we can already kind of understand what the most important asset class is that's driving the return. So in the 70 portfolios, the bulk of it invested in equities, meaning that we have to really look at what the equity markets have done in order to kind of understand what the portfolios would have performed at. So looking at the local equity market as measured by the SWIX, so in the skeleton range, the SWIX is what gives the skeleton range the local equity exposure. In the signature range, there's a little bit of the SWIX as well as some active managers. And we can see that the SWIX gave us 35.4% over the last year. So really good double-digit returns. There's also quite a sizable portion of the portfolios that are invested in bonds. And we can see that bonds over the last year have also done well, giving us 11.1%. And as per Regulation 28, about 30% of the 70 portfolios are invested overseas. So how did overseas markets do? while the developed world gave us 9.4%, whereas emerging markets, so emerging markets are countries such as, South Africa's an emerging markets, China, Brazil, those kind of countries, they outperformed the developed markets and they gave us 17.5%. If you look a little bit further down, you'll also see that the rand has actually strengthened against the US dollar by 22% over this period. Now, when we're investing money offshore, when the rand strengthens, it does impact the rand return negatively, but the opposite is also true. So there's times where the rand is weakening, like we saw in 2020. There was periods of time where the rand was really getting weaker and weaker, and in those times, it really helped to invest outside of South Africa. So when the rand is weakening and you invest money in US dollars, for example, when you convert that dollar return back into rands, then it really does add even more positively to your rand return. But now that we've seen the rand strengthening, we have seen that the offshore component is slightly lower. So it's not to say global markets have not done as well, but the exchange rate does play a role as well, which is great from a diversification perspective. So long-term performance, it's all good and well sometimes to look at, the single number, what did the markets do as at the end of May, or just for this month, or just for this period. But it's nice to look at performance over the long term, because for most of the members in the retirement funds that you look after, the performance, members will be invested in these portfolios for quite a while, and they will be riding the ups and downs of the volatility in the markets. So this is a really nice visual representation that shows us how the various life stage 70 portfolios have performed against this black line, which is the Global Large Manager Watch median. This black line is the median performance of these managers that are listed at the bottom of the table. And it's well accepted in the industry that if you can beat this Global Large Manager Watch consistently through time, then your portfolio has done very well. So it's quite clear, you can visually see that all three of these red lines have outperformed this Global Large Manager Watch median, meaning that all three of these portfolios have performed phenomenally well over the long term. What we can also see is that, yes, there is growth. So what this shows us is what would have happened to 100 Rand invested once back in May 2012. Why did we choose the dates of May 2012? Well, this is the date where the Synergy range was started. So if they're all starting at the same starting point, then you can see how the money would have grown in the funds. So it's also quite clear to see that there are ups and downs, as much as we can clearly see that this 100 Rand has grown in value. It's not growth in a smooth line. As we said, we do expect with equity markets, there's lots of ups and downs, but it's important to, to stick to your long-term investment strategies and to not pay so much attention to the shorter term market noise, to know that you are invested for retirement one day, and that you can stomach this volatility of the ups and downs. So we can see that these portfolios have all done very nicely over this period since 2012. Now let's look at the performance. The numbers that, again, we focused on the 1 year numbers when we looked at how equities did, how bonds did, how the offshore did. So again, let's focus on the 1 year numbers here. So all three of the 70 portfolios have done really well, all giving us more than 20% return over the last year. We can see that Signature gave us 22%, Skeleton, which is a totally passive one, 20.7%, and the Synergy range has done really well, giving us 24.8%. The benchmark is 19.1%, and we can see that all three of these are ahead of the benchmark of 19.1%. Now, you'll see on this line over here, we explain what the benchmark is, and you'll see that it's 48% SWIX, 30% all bond index. So what is a benchmark? Just to explain it in a little bit more detail, a benchmark is essentially a standard against which you can measure the performance of a portfolio or of a manager. And the benchmark for Signature and Skeleton 70 that we looked at on the previous slide is 48% SWIX. So 48% of the portfolio is compared against the performance of the SWIX index. So the equity portion is essentially compared against the passive index, which is the SWIX. Likewise, for the bonds, you could have an active manager managing the bonds, but you will compare that active manager's performance against the all bond index, which is again just the passive index. 11% of the portfolio will be compared against the cash benchmark. On the offshore side, we're comparing against the global index, and when you put these percentages together, they make up 100%, and this is what we call a composite benchmark. So essentially, every little asset class is compared against its passive index. How have some of the active managers performed? Again, just for consistency, if we again focusing on the 1 year, we can see that the Islamic portfolio gave us 22%, Allen Gray 21.5%, Coronation has done really well over the last year, 30.8%, Ford, one of the worst performing, but still giving you a healthy double-digit return, just short of 16%, and then 91, which is Investec Asset Management that rebranded, has given us 21.8% for the 1 year. So with active managers, we do expect them to have very different performance. They try to differentiate themselves from one another, and they, tend to have more concentrated, high conviction type of portfolios. They follow different processes and philosophies, and that's why we don't expect their performance to be exactly the same. We also know that, one asset manager may be at the top of the ranking tables today, like a Coronation, but we may look, at the end of the year or next year, and it might be another asset manager like Ford that is the best performing. Now, in terms of asset allocation, so we spoke about asset classes a little bit earlier. We spoke about the mix between bonds and cash and property. So what does that mix really look like? So we've looked at the performance. We know that the bulk of your assets are invested in equities, especially in the 70 portfolios. But what does the asset allocation look like of these portfolios? Well, I'm going to focus on this column far to the right, where members are expected to spend the majority of their working lives. And the asset allocation that we follow over the long term is as follows. About 48% of these portfolios are invested in equities, or in South African equities. If you add up this 48% in South African equities with the 22% in global equities, this is how you get to the number 70. So you'll see that 70% of the portfolio is invested in equities. There's 13% in bond, there's about 10% in income, 1% in money market, strategically about 4% to global bonds, and a little bit into global cash to the likes of 2%. So as you can see, nice diversified mix of assets. We're not just saying let's invest it all in one place. It's Regulation 28 compliant, and it's a good mix of various asset classes. Then, once we've decided on an asset allocation, we then need to decide on what managers or strategies we need to employ in order to implement on those asset allocation decisions. And in the Signature range, we know that the Signature range is a blend between active and passive. That's why in the equity space, you'll see the Sygnia Swix tracker, which is passive, but we couple that together with some active managers such as ABAX, 91, and Coronation. Likewise, in the bond space, you've got the Sygnia Passive Bond Fund together with Coronation. So it's that blend between active and passive. And on the offshore side, it's all passive, and the offshore portion of all three of these ranges is exactly the same. The skeleton range is the low-cost passive solution. So what you'll see is that there's no active managers in here. So in the equity space, we just have the Swix tracker. So it's there to be low cost, and there is no coronation or ABAX or 91 there. Again, the offshore portion exactly the same. And in the synergy range, that is mostly active. On the local side, the offshore side is exactly the same, as I said, between all ranges. You can see that we have divided the portfolio between a number of asset managers. So in the 70 portfolio, you've got Allen Gray, Coronation, 91, and Prudential, that each have a slice of the portfolio, and then it's up to them how they want to invest between equities, bonds, cash on the local side. And then lastly, we looked at the returns. We've spoken about risk. We've spoken about various asset classes. Excuse me. So let's see how these life stage portfolios stack up on the risk and return spectrum. You'll see again risk on the horizontal side. The further right you look, the more risk the portfolio is taking on, and then the return is on the vertical axis. You'll see that there's various other competitors that have been included on this chart. And essentially for every level of risk, you want the top performing portfolio. So if we look at the Signature 70 fund, for example, taken on about 9% of risk, and it's this little red square over here. And for this level of risk, it has been the top performing portfolio. Likewise, Synergy 70, a little bit more risk, but it has been the top performing portfolio. What you don't want is portfolios that have taken on even more risk. So for example, some of these portfolios that are here to the right, like Momentum Flexible 7, Sanlam MM70, for example, they're further right than the Skeleton 70, Signature 70, and Synergy 70, meaning that they've taken on more risk, but looking at their corresponding return on the y-axis, you can see that they have not been rewarded for the risk taken. So overall, from a risk and return perspective, very happy with how the life stage ranges have performed. So that's all I have for you today. We are almost out of time. I've spoken almost for the full hour. I hope that the presentation of going back to basics has helped. Understand some of the concepts. It's always good to, keep it simple and to try to, as much as we often use a lot of jargon, we try to keep communication simple and to explain these concepts in the most easily to understand way possible. So I'll be happy to take a few questions if there are any. And if not, you're welcome to get in contact with me after the webinar should anything be unclear. Okay, I don't see any questions at the moment. So with that, I thank you for spending the last hour with me, and I hope you have a wonderful week further.